The views and opinions expressed in this broadcast do not necessarily reflect or represent the views and opinions of WBGR Network. Any questions or concerns about what is said should be directed to the show host, whose information will be provided upon request.
Already?
It's ready?
It's ready?
Welcome,
Let's
Talk
Talk
Money
Money
2020.
2020.
Let me
Let me
turn my volume down because something is definitely not going right. Just give me a sec here. All right. Welcome to Let's Talk Money 2020. It's Friday, my favorite day of the week, because I get to talk about topics that money topics that we kind of experienced during the week. As you know, if you looked at my past videos, I'm talking about understanding financial statements. We want us to make sure that we can actually break a company down, understand whether a company is doing well, whether it's doing poorly, just to give a real good detail explanation of how a company is actually doing. So what I want to talk about is something that happened this week and the prior week. One is this whole notion of stock splits. I don't know whether you heard or not, but Tesla just announced that they will be giving a 5-for-1 stock split. Now, Apple announced 2 weeks ago that they would actually give a 4-for-1 stock split. I'm going to explain what that means. Don't worry about it if you don't understand what it means, because when I get finished, you will definitely be able to talk to anybody about stock splits. Stock splits are a big deal, so just hang in there with me. I guarantee you that you'll knock this dead. You'll know everything that there is to know about stock splits. So I want to talk about that because there's an opportunity here to actually invest in certain companies, but on the backdrop, I want us to understand that, hey, look, it's not about just a company's stock price. We have to look at the underlying fundamentals about the company. We got to look at its financial statements. We got to understand what these companies are all about. So what I'm trying to do is I'm trying to give us a little bit more detail, a little bit more understanding of how financial statements work. So let's get right into it. So, like I said before, Tesla and Apple, those are the two big names, just announced that there's going to be a stock split. So let me just talk about Tesla first. All right. So the way these stock splits work is, just suppose you own one share of stock, right? And let's just say you own Tesla. Now, Tesla is selling for about $1,600. So to the average person, you can't really buy a lot of the Tesla stock now. If you were one of the fortunate people that bought Tesla many years ago, 10 years ago, where you could have purchased the stock at $10 a share, you were one of those people that had a lot of foresight, a lot of belief in what Tesla was all about. So Tesla was selling at $1,600 a share. And what the stock split does, it allows people to actually, who would not been able to afford Tesla, to actually afford Tesla stock now. There's a lot of reasons why a company would do its stock split. Now hold on, I'm gonna give you a definition of a stock split in a few minutes. But the main thing why a company would do something like a stock split is they want to increase cash. It's really a cash grab for the actual company that's doing the stock split. And also, like I said before, other people can actually afford the stock now. So the way the stock split works is this: if you're holding one share of Tesla, for example, on a certain date, in this case, it's going to be August 31st, you will own 5 shares of Tesla. So if you own 1 share, that 1 share is going to be redeemed, and you're going to end up owning 5 shares of Tesla. Okay. So hopefully they have this up on the screen. I want them to see my screen now. So all right. So let's just walk through an example with Tesla. So like I said before, it's selling at $1,600 a share. However, what I'm going to do is I'm going to round that number down to about $1,500 a share, so the calculations come out even, so I won't have a lot of cents, or I won't really cause any confusion. So all I'm doing is just saying, okay, what if Tesla is actually selling at $1,500 a share? It just makes the calculations a lot smoother for demonstration purposes. So now Tesla today, like I said, we're going to say they're selling at $1,500 a share. On August 31st is going to be the day of the stock split. They're going to take your 1 share and give you 5. But what that does is it really dilutes the per dollar value of the share of the stock. So each stock now is going to be worth, theoretically, $300 a share. So if you take the 300, multiply it by 5, your 5 shares, then your total, your each share is going to be worth $300. If you take the 300, multiply it by 5, you're going to get the $1,500 share. So from a aggregate standpoint, you haven't lost anything. It's just the value of the stock is going to be split up between the shares that you receive. Pretty simple, right? Very simple. All right, so just give you another example. If the share was selling at, say, $100 today, and they did a 5-for-1 stock split, or just say a 3-for-1 stock split on August 31st. So if you did a 3-for-1 stock split, and your 1 share was worth $100 today, then on August 31st, your stock would be worth $333.33. Right? So you're gonna have 1 share, and you're gonna take that to, you're gonna own 3 shares at the end of the day. Just suppose it was a 4-for-1 stock split. It works the same way. So if you own 1 share, at the end of the day on August 31st, or whenever that projected date is that they'll issue the stock split, if your shares are worth $100, 1 share, then what's going to happen is once you get your 4 shares, instead of the 1, you're going to have 4, then the value is going to be dropped down to $25 a share. So you follow me? It's real simple. It's not complicated at all. When you listen to a lot of professionals, they try to make it sound real complicated, but it's really not that complicated at all. But I'm going to show you basically what the value is in the stock split, and why companies would do it. And when I walk you through this exercise, you'll understand exactly why this is done. But you see one of the reasons. Remember I said that more people can afford the stock? I've already explained to you that one objective. See, at $1,500 a share, it's only so much that your average individual can buy of Tesla, right? Now there's another company that's gonna actually do this, and this is Apple. Apple's gonna do a stock split on the same day. So if you could not afford Apple, because Apple is selling at, I think, $400 and some a share now, or you could not afford Tesla, who's selling at $1,500 a share, now you're going to be able to actually buy those shares of stock. And what you're hoping in really in years to come, that the value will get back up to the $1,500. All right, so today each share is worth $300. I just have 5 more shares, well, actually 4 more shares to make it 5 shares. But you're hoping that it's going to get right back up to the $1,500. Now, what usually happens is they don't get up to $1,500 immediately. So some people try to play this game where they buy the shares and they expect the big jump up in the stock in the next 2 months, 3 months, or whatever. It doesn't quite happen that way. It rarely really ever happens that way. you have to wait for years and years and years before. When I say years and years, you wait 3, 4, maybe 2 to 5 years or whatever before you see a real huge jump back up in the stock. So just suppose in a few years the stock got back up to $1,500. That means each one of these would have a gain now of $1,200. So you started off your initial investment with that one share, and a couple of years, hopefully, if you've done your research and you invested wisely here, then hopefully that in a few more years, assuming that the stock really retains its original value, then it jumps up to $6,000. So you went from $1,500 to $6,000. So you get the concept here. So just suppose in 2 years the stock is really performing well and it jumped up, the company might just give another 5-to-1 stock split. In that case, you're each share that you have, again, you're going to go through the same cycle. You're going to trade in your 1 shares, and you're going to get 5 shares, worth that value. You can't predict if it does it again what value it's going to be. The stock could be just anywhere at that particular point. So let's just narrow it down to this case that we're talking about today. So just to give you an example of the power of these stock splits and the actual potential of these stock splits, let me just run you through an example. Just suppose on today you own not 1 share, but you own 2 shares of the stock. So if you own 2 shares of the stock, remember what our imaginary number is $1,500 a share. It's really selling at $1,600 a share. So the initial value is $3,000. If you waited a few years and you waited till the stock actually regained its glory days at $1,500, if it does, and it could be a big risk, it may not ever get back to the $1,500, but you're banking on it takes a nice bump up in the stock. You might not get back to $1,500, but let's just assume that you get back to $1,500. You had initial value of $3,000, because remember it's two shares at $1,500. So your initial value, on before August 31st is $3,000. So what's going to happen is after a couple of years you're going to have $12,000. So if your initial value, initially you had 5 shares at $7,500, after a period of time, and just suppose it recoups its original price, you would have $30,000. So you went from $7,500 to $30,000. Okay. Now let's just jump here. Say you own 100 shares of Tesla, right? That's worth $1,500 or more, because the stock price is more. So after you waited a while, and hopefully the stock would have gotten back up to $1,500, then you would have your stock would be worth $600,000. So if I skipped again and say if I was fortunate enough to own 1,000 shares of Tesla, okay, today that market value will be $1.5 million. Okay, but if you waited to the stock after the stock split, the 5-for-1 stock split, if you waited until the stock actually regained its value again, you would have $6 million. That's a pretty good scenario for anybody. So let me just run one other thing to you. I'm going to show you the power of this thing. If you were, just suppose you were one of those fortunate people that you bought 1,000 shares 10 years ago or whenever Tesla started, and you purchased those shares at $10 a share. If you did that, then your gain per share today, I'm not even talking about the day the stock splits. I'm just talking about today. And if the value or the gain on that internal gain on that stock, each one of those shares would have been $1,590 before the stock split. Okay, so at 1,000 shares, you would be sitting on today, if you had invested, $10,000. That's $10 a share at 1,000 shares. That's $10,000. If you invested $10,000 back 10 years ago, then today you would have $2.5 million, $2,528,100. That's how much your stock would have been worth before the actual stock split. Okay, so that's a pretty good deal there, but you would have to have the foresight to invest it way back in the day. So not only would your stock be worth the 2,528, just suppose that you kept those shares after the stock split, and you waited. Okay, so what would happen is you would be in this category here, and you would have another 6 million after the stock had it really got back to its original value. So you would have the value that you have today, the 2.5 million, plus you would have waited until the stock got its value back, and you would have got another 6 million added on to it. So you would be sitting on about $8.5 million after the stock, after 2 to 5 years from now. But you would have to been really, really fortunate and really had invested in this company a long, long time ago. So you would have went basically from $10,000 to $8.5 million. Pretty unbelievable. So like I said before, Apple is going to do the same thing. Apple is, their stock has really risen to a point where it's selling at, I think, $458 a share today. So Apple really feels that this price is really high, and if you were trying to get into the market and you were trying to buy Apple stock, not many people can really buy Apple stock or buy in large quantities at $458 a share. So they're not going to do a 5-to-1 stock split. They're going to do a 4-to-1 stock split, and this is how you value it. You value it the same way. You just take your per share price divided by 4. Right? So instead of having 1 share, you're going to have 4 shares. So you divide that number by 4, and then the day that you do the stock split, theoretically, the stock is going to be worth about a little bit over $100 a share. So as you see here, you would be able to buy a whole lot more Apple on its stock split conversion date than you would Tesla. So Tesla's stock will go down to about $300 a share, and Apple would go down to about $114 a share. So the numbers won't be exact because certain things happen in the market, and those dollar values won't be exact, but they will be around that range. So the good news is the good news is that these stocks are going cheaper. And what I'm going to do is I'm going to go into understanding the financials on both, and I'm going to take a break, and we're going to come back, and then we're going to actually talk about why one might be better than the other. So let's take a break, and we'll be right back.
Hi, I'm Troy Emery. Here at TD Emery & Associates, we offer a wide variety of business tax services for small and large companies, including corporations and partnerships, nonprofits, and real estate taxation. Also, we offer audits, compilations, and reviews.
Let our knowledgeable staff at TD Emery & Associates help you optimize your tax benefits today. Dependable, accurate, trustworthy. TD Emery & Associates. Dependable, accurate, trustworthy. TD Emery & Associates.
What is this? The IRS?
We know that your tax preparation requires more than just the basics.
Hi, I'm Troy Emery, and I've spent my entire professional career helping taxpayers in a variety of tax issues. Let us show you how to confront and solve tax issues with every viable option under the law.
Call the tax team at TD Emery & Associates now.
All right, so we're back. So we talked about stock splits in the last segment, and why stock splits are very, very important. Now that you know that you can afford certain stocks because of the stock split, you cannot get around looking at the fundamentals of the company, right? Because just because a stock becomes affordable doesn't necessarily mean that it's a great buy for an investor. Okay, for one thing, you want to hold on to these stocks as long as you can after you buy in the stock split. Okay, So it's a long-term play. I would not recommend this for people that day trade, because the stock is not going to move that fast. So the thing is, I want us to really try to understand, really evaluate which stock split is going to be better. Is it really worth it to really try to invest in these companies? Now I can tell you one thing, that the more, it's like everything else, the more risk that you take, the bigger the reward, but it's also the bigger the losses that you can take. So if you want to compare the Apple stock split to the Tesla stock split, I'm going to tell you straight up, Tesla has more risk. The reason why they have more risk is because, if you think about it, Apple has been profitable for a long time, and Apple will continue to be profitable. All right, but theoretically, Tesla actually just made its first profits this year. So you got to be thinking, okay, well, if something were to happen, in the car market with Tesla or whatever, then Tesla might experience losses again, stock price falls, whatever. But if you go with the more solid pick is going to be the Apple buy, because the chances of them becoming unprofitable is probably not as great as say Tesla. Now, for example, if you look here, let's go all the way down here to the bottom. If you look, this is the second quarter of 2019. If you go all the way down here and you look at the losses, you see in the fourth quarter they lost money here. So and if you look on the second quarter of 2020, you see they're positive here, and they were positive for the first quarter as well. So if you want to just do a comparison on net income, certainly if you look at Apple's income statement, you're going to see that they make money every quarter. Now, it doesn't mean not to buy Tesla. I'm not saying that, but what I'm just saying is the risk is higher. So you have to really, I'm trying to get you to understand, you have to go look at these financial statements and then make your own judgment as far as which way to actually go. Tesla, you got to look at Tesla stock. Tesla stock was selling at the beginning of the year, maybe $400 a share. Now it's up to $1,600 a share. So if you really think that stock is going to continue to climb, then yeah, if you believe that, then it might not be a bad investment for you. But I would, me personally, I would be looking at this and saying, wait a minute, you've only been profitable for 2 quarters, all right? I can't really bank on that. I need some more assurance before I start dumping a whole lot of money into Tesla. I mean, that might, because it's selling at $1,600 a share, it might mean that the stock is way overvalued. So if the stock is way overvalued, then Tesla understands, hey, look, we think that our stock is overvalued, and therefore we're going to do a stock split and try to get as much cash as we possibly can. And that might be the play. It's a good play for Tesla if really that's their strategy. So, but when I look at the financial statements, I cannot say that this is a company that you can definitely be sure that you're going to make a lot of money in the next few years. If you look at what's been happening here, and what I usually do is I try to really look at certain scenarios. I try to look at these financial statements and try to understand where the company is going, where the company has been. Just real quick, if you look at the details of Tesla, the older models, the Model X and the Model S, if you look here in the second quarter, they sold $15 billion worth here of cars. But look at the low end cars. They sold $87 billion of the low end cars. So that tells me one thing. Tesla has to continue to be innovative and have to have like cutting edge cars and at affordable prices to actually make sure it really maintains its electric car dominance. Now there are other players that are coming into the market over the next year or two. Is that going to dilute the company's earnings? You have to look at those type of things. You got to look at what's in production. What are they planning on doing with their cars? Is it going to be so far above everybody else, and will they continue to maintain this dominant market? If you don't think that this is going to happen, then it may not be a good deal for you. Now Apple, on the other hand, they always have had solid phones, even though I'm not an Apple user. They always had solid phones. They always did well in sales, and you cannot really say that they're going to do bad in sales. They don't have these major competitors that are competing with them. So there are a lot of things that you want to think of, but make sure we look at the income statements. I didn't have time to really get into the income statement this time, but I at least showed you the sales. I showed you the older cars versus the newer cars and how they're going to do, so you make certain opinions about where they're going to be in the future. So, and just stay tuned. The next broadcast, I'll break down these financial statements a little bit further. We'll have another week or two before the stock split is already done, and I'll get a little bit deeper into the financials. So until that time, I'll see you next week. Stay safe.
Hi, I'm Troy Emery. Here at TD Emery & Associates, we offer a wide variety of business tax services for small and large companies, including corporations and partnerships, nonprofits, and real estate taxation. Also, we offer audits, compilations, and reviews.
Let our knowledgeable staff at TD Emery & Associates help you optimize your tax benefits today. Dependable, accurate, trustworthy.